So I have little doubt that we will see, even though growth has certainly the last couple of years been outperforming value, I think we're going to see a massive changing of the tide, but we don't have to anticipate it. We can wait till our tools tell us when that tide is turning. Hello, everybody. It's John Llodra. I'm a co-founder and partner here at New Harbor Financial Group. Thank you for tuning in for our weekly video update. The reason we put these videos out is to bring data, our insight on that data, all for the purpose of educating and empowering our viewers, especially our clients, to make more informed and live less stressful financial lives. Fresh into a brand new year, and of course the optimism and hopeism perhaps that oftentimes come along with that, especially in financial markets. I want to invite you to subscribe to our channel. We put out content every week. Just hit the subscribe button that you'll see on the screen here. Hit that little bell. It'll allow you to get notified anytime we put content out. And we welcome your feedback. Please put your comments in the comment field. We welcome your suggestions on topics that you'd like to see to help educate and provide valuable information. Give us feedback. Give us critical feedback. I would like to start by sharing a chart. This is a cover story for Barron's, and the headline pretty much sums up where we left off last year. Strong year in the stock market, but the headline basically, stocks could gain another 20% in 25. Embrace the bubble, saying the quiet part out loud. We're not inclined to want to give precise forecasts on calendar year returns here at New Harbor. And the main reason for that is it's more or less a fool's errand. The ability to do that with precision is frankly driven by one's ego, and the ego of Wall Street certainly is no small giant. And in fact, to the day almost of the end of the year, we got paraded with forecasts of Wall Street of what they imagine 2025 returns would look like. And that's what this chart shows. It shows the range of forecasts. So Oppenheimer leads the list. They were projecting a 20.6% return for 2025. The party pooper in the bunch was Cantor Fitzgerald, only predicting about a 2% return for 2025. The average is about 12.3. All well and good, but let's remind ourselves of the track record of Wall Street analysts. And the right side of this chart basically speaks to that. This goes back to the year 2000. The pink bars show the range of forecasts of returns for the following year predicted by Wall Street, and the black diamonds show the actual returns. So for example, in 2024, here was the range, but the market blew away most people's expectations. Contrast that with 2022, where there was a majority of analysts were predicting positive returns, yet the returns for the stock market in 2022 were quite negative. At the tech bubble of 2000, especially look at 2021, not a single analyst had a negative forecast. In fact, even the most pessimistic forecast was a pretty soundly positive return, yet it was a very negative year. Really just speaks to the folly of trying to predict with that kind of certainty the price movements. And I would say that it's not even that important in the context of the kind of investing timeline and lifespan of the kinds of folks that we serve. Real people that have largely worked hard, saved, built a retirement nest egg, and need those savings to work well for them and be sustainable, not for the coming quarter or the coming year, but for the entirety of their life, and hopefully something left over at the end if they have inclinations to pass on a legacy. You won't hear a forecast like that from the folks here at New Harbor, but what we do is we do dive into the data and gain conviction about the likely direction of markets, and recognizing through humility and lessons learned that if you become too certain about something, you're almost destined to have your head handed to you on a platter. What I'd like to do with today's video, I want to bring it away from the year end and beginning of the year kind of hoopla, slogans, headlines, flashy forecasts, and really focus on two key tenets of investing that I think are really important. So the first main tenet that I'd like to reinforce here, and it's a timeless lesson that people need to learn over and over again, is that valuations do matter. Stock market valuations do matter. Now, I'm the first to admit that we here at New Harbor have been raising the warning flag about high valuations in the stock market for some time. And that's the nature of bubbles. We think we're in a bubble, and one that has been progressively expanding. The definition of a bubble is that already extreme valuations can get even more extreme. The true definition of a bubble is a psychological phenomena. It's the suspension of disbelief. It's the belief that the greatest new thing has changed the rules, that this time is different. You might say that today, that new thing is AI stocks. So I want to bring folks back to valuations. Valuations do matter. They don't matter in the short term. In fact, they can be very horrible short-term timing tools, and we're the first to admit that. But what is undebatable, and I challenge anybody to show me data that speaks otherwise, they are very, very good predictors of returns over, say, like a decade. And that's really the kind of time frames that should matter to most folks, most clients of ours. Left-hand side of this chart, Federal Reserve Governor Lisa Cook delivered a blunt message about the stock market, basically raising the warning flag that valuations are elevated in a number of classes. Usually when you see Federal Reserve officials warning about a bubble, it signifies that they're feeling like they're boxed in with their policy. The bottom line is the markets have gotten so jubilant that the Fed is worried about excesses. The economy is very hot. Optimism is super hot. These are all things that go hand in hand with a market that is extremely overvalued. So the Fed I think, is trying to jawbone the market into doing some of its work for them. A deflation of overvaluation can create softer or easier financial conditions and do some of the heavy lifting for the Fed. But let's look at the data here. This upper right-hand corner chart is a valuation chart that was just updated by John Hussman, a hallmark metric called non-financial market capitalization to non-financial gross value added. It's basically like a price to revenue type of statistic. And this has statistically been shown to be the most robustly correlated with subsequent returns, say over the next 12 years. We're at a level now that eclipses all points in history. Higher than 1929, higher than the tech bubble in 2000, higher even than the peak at the end of 2021. So we are in not just rare territory, but the most extreme territory ever. And why that matters, this chart here shows the relationship of this time series with the actual S&P 500 returns over the subsequent 12-year period. You see it's about as tight a relationship you will find in statistics. And at least at the beginning of November, we were at the single worst point in history in terms of prospective returns. This suggests prospective returns of negative 6% per year over the next 12 years. Sounds absurd. It is absurd. These kinds of things happen and can happen when valuations get as absurd as they are now. Now, John Hussman would be the first to point out this isn't a forecast. Even if we look at the favored metric of Wall Street, which is flawed in so many ways, but has a looser relationship with forward returns. Even if we look at forward PE ratio, going back to 1988, I believe, and here we are right here. And if you look at this history, it basically shows that the 10-year annual returns, anytime we've been in the range we're in right now, have been no better than about 2% positive annual returns and have also reached about -2. These are not the kind of returns that people have become accustomed to. Certainly doesn't match the kind of returns that the Wall Street analysts forecast. I will give credit to some Wall Street firms like Goldman Sachs, BlackRock, Vanguard, in their own way, raised the warning flag about very disappointing returns over the next decade for U.S. stocks. Why is it so important not to forget that valuation matters? And this basically looks at a scenario of a retiree that has amassed a nest egg of $1 million. I want to talk about the sequence of return risk and the impact of valuations on those returns. On the one hand, on the left-hand side, we have a scenario where one retires at a starting point where you can say stocks are cheap. 1982, the Shiller PE ratio was at 7.18. That's historically very low. So you could say stocks were very undervalued at that time. And here were the actual pattern of annual returns. These are actual returns in the S&P 500. I've modeled a scenario where this retiree wants to withdraw 5% or $50,000 a year, but give themselves a raise at 2.5% inflation every year. Now you can see under this simple example, not only can they fund these expenditures, but the portfolio value continues to increase and grows quite substantially because the average returns and the pattern of those returns were very kind. Compare that to a retiree who retired in the year 2000 and was faced with a valuation Shiller PE ratio of 42.18. Call it 6 times the valuation that was present in 82. And what you had here were 3 very, very disappointing years in the stock market, the tech bubble bursting here. And again, you had the housing bubble here. The average return over this 15 years was only 4.1%. That's pretty bad, right? Compared to 13.3. It's made even worse by the fact that these negative returns were in the front years and not in end years. What are the implications of that? This retiree, if they were withdrawing these funds, they basically ran out of money. They went negative by year 15. Just a real simple example of how critically important it is to be very mindful of valuations, because these big down years, they're not random events as many Wall Street pundits would have you believe. They are actually very much clumped around the periods of times where valuations are very, very extreme, like they are now. Really want to encourage people to always be very careful to not forget that valuations matter, especially when you don't get a do-over, when you're in your retirement years and this is all the money you'll ever have to work for you. So I want to go to the second key tenet. Trends always change. It may feel like trends want to continue on forever, but what works in terms of investing is always susceptible to change. Now, what this shows, it shows for different kinds of asset classes, shows the top and the bottom returning investment at the bottom. So for example, growth stocks returned 28.23% in 2024, whereas dividend stocks returned only 5.24. Now you'll notice that these tiles switch around every year. Growth was very high here. It was not so hot here in 23. It was worse spot in 2022 when stocks were down. The traditional advice on Wall Street, or most advisors would say, oh, this is a random thing. You don't know what's going to lead when. So your best investment strategy is to invest in everything and never change your mix. And that's an okay way to think about things. But there are major extremes in markets where we think there's every bit the ability to avoid things that are likely to perform poorly and overweight or get into those areas that are likely to perform very strongly. So I'd like to share a little bit of the toolkit that we use here at New Harbor to help guide our hands on behalf of our clients as to those areas of the markets that are gaining leadership or starting to lag and lose that leadership. One of the key tools we use in our discipline is a concept called relative strength. Here we are nearing the end of the college football bracket season, and if you think about sports brackets, they are rankings based upon the performance of given teams, and they're certainly, well, relative strength is a similar concept, but applied to investment categories. This is a quilt of various asset classes and subsectors. So you have domestic equities at the top and fixed income at the bottom. You get international equities, commodities, cash, and currencies. And this is a actual ranking of different kinds of asset classes by relative strength. So the green areas are relative to other areas. So for example, domestic equities is ranking by a long shot a higher relative strength than all these other asset classes. You can see this tally count here, 329. But suffice it to say, it's got a very large leadership in terms of relative strength compared to all these other asset classes. Within there, we can look at sectors, and we can see that the financial, technology, communication, industrial services are the top 4 highest relative strength sectors. Compare that to energy, which has been a horrible investment in 2024. Not because it's overvalued and not because of this or that, but it just simply has been out of favor. Same with healthcare. This is a very simple way to look at how we can systematically identify emerging trends and emerging leadership and emerging laggards, for that matter, to help navigate that investment quilt that I just showed you, so that we have a greater probability, greater chance of leaning into those things that are likely to outperform and lean out of those things that are likely to perform very well. What might cause these things to turn? Like, I do think that we're going to see some major changes. The top pane shows since 2000 the performance of the iShares S&P 500 Growth ETF, large cap growth, and the S&P 500 large cap value ETF. And you can see over this long period of time, the growth one, the blue line, has outperformed the value. But notice this, during the tech bubble here, value greatly outperformed growth. And you can see that in this ratio chart in the bottom. When this line is going down, it means that value is outperforming growth. And when it's going up, like here and here, it's showing that growth is performing better than value. Now we can use relative strength tools to capture or identify these changes in trend. And that's exactly the kind of tools we bring to the table in trying to make these tactical decisions for clients. So I have little doubt that we will see, even though growth has certainly the last couple of years been outperforming value, I think we're going to see a massive changing of the tide, but we don't have to anticipate it. We can wait till our tools tell us when that tide is turning. Let's look at US stocks versus emerging markets, foreign stocks. Probably one of the most frustrating areas for us, because soundly these stocks are way more undervalued than US stocks, the emerging market sector. Yet they have been laggards for most of the last decade. As you can see, this lower pane here shows the ratio of the S&P over the emerging markets, basically steadily rising. That means over that time frame, the S&P has been steadily outperforming emerging markets. And that's why you've got this big outperformance. But notice in the first part of the decade that followed the technology bubble, you had this declining line here, which meant that emerging markets were outperforming the S&P. And that's why you had this outperformance here that frankly lasted all the way to 2020, even though for much of that time frame, the S&P, the US stocks were playing catch up in a big way. Just a very simple way to look at long-term returns. Again, I think the key takeaway here that we'd like to say is that What worked in the rearview mirror is not likely going to continue working in the front view windshield. Basically, December was a pretty weak month in stock markets and much weaker than the headline S&P 500 would have told you. I think the S&P 500 cap-weighted index was down about 1.25% for the month of December. The same 500 stocks, if you equal weighted them, were down about 6%, I believe. So what's going on here? And I want to point to a picture here that I think explains a lot of this. This basically shows the percentage of stocks that were outperforming the S&P. And you can see a record low percentage of stocks, only about just under 20% of the stocks were actually outperforming. So you can see absolutely going back to the mid 80s, never before have so few stocks outperformed the index itself. Why is that? Because we had very horrible market breadth. It was basically just the Mag 7 stocks and a small handful of others that were doing very well in December, but the rest of the market was imploding beneath that. The other key development here that has really roiled markets is what's happened with interest rates. In a nutshell, long-term interest rates have shot higher quite dramatically, even while the Fed has started to reduce rates. They started reducing short-term rates in September of last year and completed a total of 1% of cuts in December. So the red line shows the Treasury yield curve on September 17th, 2024. This is a day before the Fed began its cutting campaign after 14 months of pausing. And then this blue line shows the yield curve as of January 7th. And what you can see here is that the short end of the curve has predictably declined quite a bit. And this is because the Federal Reserve has moved this short-term Federal Reserve fund rate down a full percentage point. So you can see we went from 5.25 down to 4.25 target range. But the long end of the curve has shot up. You can see the 10-year yield, for example, went from about 3.6 to about 4.7 over that time frame. This has caused a rather abrupt kind of roiling of markets. Certainly the bond market has sold off, and we think it's starting to have some implications to the stock market. We can talk about why we think the bond market has sold off. I think it's a combination of concerns about the federal deficit, concerns about inflation starting to resurge, and even things like so-called term premium, the risk that investors place on longer term treasuries versus just simply rolling shorter term treasury bills. That risk premium, that term premium has started to rise pretty dramatically. We think a lot of the damage in the bond market has already happened, but we're not ruling out that there could be further. Right now, as we speak, the 10-year yield on the treasuries is about 4.6, 4.7. We think it's a pretty good chance we revisit the 5% level on those yields that we saw in the October of 2023, I think. And we even can't rule out that yields go quite a bit higher from there. I would not rule out a scenario where we see 6% yields or even more. It's not our base case forecast by any stretch, but we have to allow for that scenario. And that's why we're holding a very, very small position in long-term treasuries. We're not inclined to want to add to that, at least not until we see some further pullbacks there. Suffice it to say, we're in a very tricky time. And ultimately, I think the bond market is ultimately what will cause the stock market to fall under the weight of these tremendously lofty valuations. I would say bubble conditions, both valuation and sentiment-wise. But we, of course, will be here every week reporting on our take on things. So I want to thank you for watching. Again, please feel free to like and share this video if you think it'd be valuable for others to see. But until next time, thank you and have a great day.